Okay, good morning everyone. Welcome to our weekly webinar. Once again, thank you for joining us, taking the time out of your day to tune in to a quick sort of 30 minutes or so of discussion and information that we believe you'll find valuable. So let me quickly move on to our user introduction to our normal co-host, myself, David Johnson, CEO of LEOcrowdfunding, and my co-host, Mr. John Corey. Good morning, John.
Good day.
Yeah, and today we're delighted to be joined by Avina, who those of you who attend regularly will know Avina is our investment analyst at LEOcrowdfunding. Comes from a master's background in sort of real estate investing. And Avina, thank you for joining us today. Hope you enjoy your time on the webinar.
Yeah, actually, just so it's super clear, she has a master's degree. Is that from the Cass Business School?
Yes, it's from Cass Business School in real estate investment.
There you go. So master's degree in real estate investment, and like professional full-time analyst who studied this for years. So actually much more serious background than many of us.
Much better than numbers than me, for John, that's for sure.
That's why I want to clear, so the people know that Avina is there to help with the numbers.
Yeah, very much so. Okay, so yeah, let's do a quick market update before we dive into our topic for today, which I think is going to be really interesting, again, for those who've joined us. So just by way of property and market update, John, we have again all these big headlines screaming out of the newspapers and the Facebook and LinkedIn. House prices surged to a record high, according to the Halifax, and it was in August. Then you have sort of on the side of that, sellers lose more than 600 million a year in property fall-throughs. I thought the one on the right was interesting, that the house prices, according to the Bank of England, are not due to lack of supply, which very often is a driver for increased house prices. So, yeah, what's your sort of take on the Bank of England's comments and just in general the headlines we're seeing?
So I haven't read what the Bank of England actually said versus what the headline writer wrote. And that's not the Bank of England that wrote that headline. You know, there's pent-up demand. People couldn't buy. People still want to get on with their lives. As I've said repeatedly, the virus hasn't killed that many people to actually impact the number of housing units we need. People still want to live somewhere, and they still need to live somewhere. There's a lot of uncertainty in the job front, and people's income does have a big impact on whether they'll commit to purchasing. That said, a fair number of people have also working very efficiently from home, so their incomes seem pretty stable, so they're willing to move forward. There's a lot of turbulence out there, and you need to look past the short term and look at the 3, 5, 10-year time frame. In 3 years, everybody's certain we're going to have a vaccine. So in 3 years, are we back to normal? Well, can you get through the 3 years and then back to normal? I don't know if we will be back to normal. I think fundamentally, we're going to see a shift in how people work. So,
yeah, interesting. And as we were saying earlier this morning, we had a brief conversation that if you were to make comparisons, even to the 5 or 6 months we've been doing this webinar, and compare the headlines that we've kind of shown over the months, that would actually make interesting reading.
Yes. Well, even if you didn't read in any depth, you just looked at the recordings on the YouTube channel that LEOcrowdfunding has, and you look at this one slide over a number of weeks, you'll see quite a bit of change. And these headlines and these articles are written to sell newspapers or magazines or to get clicks on a website. These are not investment advisors. And the people writing this stuff may or may not have any background with property investing. One headline that's not here, because it'd be boring to the public, but it might be relevant to all of us, is the FCA's new consultation. The consultation that's running since June has now closed as of today, or maybe technically tonight, depending on how they count. And that will roll in some new rules or make permanent some of the rules that are temporary right now, and will stop people from doing certain things when it comes to raising money. So, you know, that's a headline that I think people that watch this session should be clued up on and focused on, rather than house prices.
Yeah, that's a good point. And when there's any clarity on that, we can again do a summary for the.
It'll be probably late this year.
Yeah, that sounds like a task for you, John, to keep an eye on that, and when the time's right, you can bring your take and your knowledge to the audience, which is grand. Okay, so in terms of a quick update on some of our projects, now there are full investor communication updates that are being prepared currently. Avina is actually heavily involved in that. I've got a nice new layout as to how we're going to update investors into each project on a monthly basis. There will of course be quarterly webinars and COVID dependent. There will be site visits. If anyone does happen to be in the areas of these two projects, I mean, you're more welcome to drive by and have a look what's going on. But the first update I just wanted to show for any of the attendees who invested in the Plough Hill View project in Nuneaton, and that is now not only closed and fully funded. The funds have gone to Creation Tech 99, but the guys, as they said on the webinar that they did, they were ready to hit the ground running, and you can see just in a few short weeks some photographs from site. This is Ray in the black hat. Ray likes his hard hats. I always keep going about those. But this is Ray with the architect actually on site, and you can see the work that's already been done. So excellent project. It's always great to see, John, when first of all fundraisers deliver on their timelines and when they're going to get started. It does breed a bit of confidence, and it's good to see this project moving already.
Mm-hmm. And I know in the photo on my right, they're definitely socially distancing. We're going to have to talk to Ray about what 2 meters means. So. Yeah,
absolutely. So I'll let you have that conversation with them. So that's the Plough Hill View project up and running. It was a 12-month investment, and yeah, really looking forward to watching this one go and get the fines in. And
just to highlight a minor little point, there were 44 investors, and it's down to 43 when it finally closed. One of the investors didn't actually perform when it comes to finishing the paperwork and everything else. And a different investor put in a little extra, so it's still at the 100,000 mark. But I want people to appreciate that these things do change. This is quite normal, and that if you're raising money yourself, you should expect that that can happen because if someone doesn't sign the shareholder agreement, they're on holiday or whatever, they miss out.
Yeah, absolutely. So yes, that's the first one then with Creation Tech with Hitesh and Ray going well. I look forward to keeping you updated. So again, really good news also on the Avon Valley project. As again, regular attenders remember, this funded literally in a couple of hours a few months ago. And again, they said they were going to be on site very quickly. And here is Ed Morgan of Bowman Homes, complete with a pair of, so if they're building regulation shorts or not, but he's got a shovel in hand on site, starting to clear the site. On the right hand side, you can see they've demolished a building that was there at the side of the property that they purchased. So again, tangible progress being made. And it's nice to be able just to update the attendees of these two projects that were funded on our site and are now making progress. So just to draw your attention briefly to the Target 5, the 35 West Buildings project, we're actually now up to £80,638 invested. Remember, the minimum raise amount on this project is 100,000. So we're almost there to the 100,000. So thank everyone who's decided this was a good investment for them. And I know a number of people are still looking at it, asking some questions, getting some clarification points. But we certainly fully expect this to get to the 100,000 at least by the close of the project. So John, again, just briefly, this was sort of a slight change in what crowdfunding platforms maybe do, not in the project itself, but how we presented it. You know,
the project is quite different in that historically, crowdfunding platforms, many different ones, focus on development projects or planning or something, tends to be short, sharp, and then you exit with a sale. This is a buy and hold. This is a buy, add value, uplift the value, refinance, that sort of thing, and hold for income. So this is what most people who are in buy to let do. They want to buy at a good price, they want to add some value, they want to pull out their cash and move on to the next one. And that's exactly what this is. So in that sense, it's quite rare to see at a crowdfunding site, but it's almost the bread and butter type project for the audience if you're doing your own deals. The other point, David, what does minimum raise actually mean?
So minimum raise means that providing the raise gets to that level, then the fundraiser can draw down the funds. So that's, if you like, the minimum amount they need to allow the project to go forward. So in this case...
So from a crowdfunding point of view, what does that mean for the investors?
So as long as the project raise reaches that, then it becomes a successful project. Those funds are drawn down, they go to the fundraiser to carry on with the project, and the investors become shareholders in that SPV. So
to everybody listening, as long as we reach the 100,000 mark on this deal, it'll go forward. You'll get a copy of the shareholder agreement. You'll be asked to review it, raise questions, eventually sign off if you're happy to go forward. But a successful raise is the 100,000 mark. So we're already 80% towards that 100,000 mark.
Yeah, and to be fair, I mean, this is already clear in the documentation. Target 5 were always doing this project anyway. They have the funds available. This was an exercise for them, obviously, to reach out to a new audience and a new method of fundraising. So if we reach the minimum target through the crowd fund, then Target 5 are quite happy to do the pay the other 42,538, which is what the gap in funding that is existed there. So it's very much Target 5 and the crowd, if necessary, will combine their income or combine their investment to bridge that gap, which is what we are looking forward to. So yeah, this is again, excited about the next couple of days. It's 7 more days to go. So literally next Wednesday this closes, and with that in mind, we're actually doing an educational webinar next Tuesday night. So it's not 100% focused on Target 5 or on this project per se. This is very much a little bit, if you like, higher level about HMO conversions in general, particularly where it's commercial to residential, and also this BRRR concept. So that's 7 o'clock next Tuesday night, 6th of October. And there's the bit.ly link, which you can quick snap on your phone or screenshot it. But I think, John, this is relevant because as COVID, continues to impact, I think there's a lot of discussion around what's going to happen with commercial areas of towns and cities, and there may well be opportunities that didn't exist before to convert commercial premises, particularly on the uppers, into residential. And I know that's something a lot of people are discussing. So I think it's a good opportunity to do a webinar about that, but also use the Target 5 raise as an example of how it works.
Correct. And this is one of a few. There's some other case studies that are examples of buy and hold. So it'll be very much the buy, add value, rinse and repeat, pull your money out, burr, whatever we want to call it.
Yeah. Okay. So let's get straight into the education side. I know Avina's indicated she's got some challenges with broadband this morning in her area of London. It's been like that actually most of the week. So I've told her if she obviously has difficulties and can't get enough for the strength of the broadband, then she can keep her camera off. And if that doesn't work, obviously she'll have to drop off the call. So you might see her jumping in and on for a few minutes here to see if it works. But education. So what I wanted to talk about today was, again, reminding people about our mission as a company, our vision. It's very much to educate the world of property investors. When I say educate, some people are already very knowledgeable, but we can increase that knowledge, and others are very much starting a journey. So our mission is very much to help investors learn while they earn how to own property assets by leveraging the power of the crowd, hence the LEO. And today we're focusing on the earn part. And well, earning can mean different things to different people. My wife Brenda sourced this image. I thought it was actually quite a cool image. Certainly, this young girl is earning some money in a way that perhaps most her age don't. But that really just focuses on what we're trying to say, that there are different ways of earning income. And
I looked at it and thought, oh, she must be Irish. She's got red hair. But then I saw the money in the box said dollars. So I guess it's across the pond.
Yeah, but I reckon she came probably from Ireland and went over there with her family. And obviously being from Ireland, a great singer, John. She's a great singer, being from Ireland as well. So
she doesn't pay tax on her royalties. That's good.
Yeah, smart. Yeah, it looks like Avina hasn't quite made it back on yet. So this is what we're talking about.
Let me dive into this a bit. So on this earning side, in property, there's a book I've read a long time ago. It's a fairly classic book. And it says there's only 4 ways to make money from real estate. And more or less, this is 3 of the 4, even though we've broken it into 4, because I think this is more appropriate here. The 4th way in the US is a bit of a tax play, but we don't have those opportunities here. So when you buy property, you might be buying it to earn some rent, the income stream that you're looking to supplement your income, you're looking to replace your income, you're looking for income for your pension. So it's a very easy one to understand that you invest in an asset to produce an income stream, and that income stream is the rent. Whether it's commercial, residential, doesn't matter. It could be a car parking space, it could be a cell tower, but you're getting paid monthly for providing the opportunity for someone to use that property. Mm-hmm. The one that tends to be more interesting for more of the people trying to create wealth and trying to grow their portfolio, particularly if you don't have a lot of money to start, is how can you add value? How can you force up the value of the project? Whether that's take a 1-bedroom into 2 bedrooms, whether that's converting a larger house into an HMO, commercial building into residential, but you're changing the property, you're putting in some sweat equity. And Avina's back, so I'm gonna let her add some comments on this. So Avina, I've covered rent. Talk to us about adding value.
Yeah, so adding value can mainly be done through development and improvements, and that can essentially add value to the asset. And some of the examples like property owners can do this is through renovation or extensions. Mm-hmm. So I'd say in a basic level, that's adding value, yeah.
Yeah, and if we were buying our own home and we're gonna put our stamp on it or our mark on it, whatever phrases people like to use, that's adding value. Maybe you're painting the walls, you're cleaning up the garden, and you're making it more presentable, and that can add value either emotionally or actually in the economics. But for property investors, it's normally the intention is to move the property to a higher and better use so you can extract your equity. You're trying to recycle your cash. You're trying to implement the BRRRR strategy. So Avina, what do you mean by market appreciation?
So market appreciation is essentially when the value of the asset appreciates, and this can be mainly realized when you sell the asset. Location has a big factor in appreciation of, for example, residential properties. If the area has better transit routes or infrastructure, the value of the asset can increase. And also inflation can play a good role in increasing property's value over time. So
yeah, so I didn't touch on that in rent, but how does inflation play into rent or market appreciation?
Yeah, so essentially inflation can be a hedge, especially when values are rising over time. So investing in real estate it can essentially be a hedge to inflation in the long term. So, yeah.
Okay, so real estate is the inflation hedge. Yeah. And let me go into the science slightly. If we stick to residential, don't talk about commercial, just stick to residential, everybody will understand that basically what people pay in rent and what they pay to buy a house is tied to what they earn. And that's why if we have a lot of people out of work, we think the market will fall. So essentially over time, people expect to earn more, they expect to get paid more. The Bank of England is designed to create a positive 2% inflation rate. So if wages are gonna go up, then what they pay in rent or what they'll pay for a house will go up. And that's underlying reason why inflation happens and why it affects housing the way it does. What's interesting is a different way to hear it is the houses or the rent doesn't change. The value of the piece of paper or whatever you want to call it that someone brings to pay the rent is going down. You're chopping 2% off every year. So you got to keep bringing more of it to keep the same property. So it's actually your currency's falling in value. It's not that your assets are going up. They're measured in terms of this thing that keeps getting worth less. So that's your little inflation lesson there, folks. Take us on to debt reduction, Avina.
Yeah, so for example, if you've borrowed money to buy a property, you can essentially refinance your loan or your borrowings at a lower interest. But also, for example, if you leverage real estate and if you've got a mortgage, you could essentially have tenants who pay you rent, and that could essentially allow you to reduce your debt over time. So that's one example of how leveraging can help with debt reduction.
Mm-hmm. So I'm the gray-haired one in the session here. So I'm supposedly thinking more about pension and retirement and all that. And if someone said to me, would you rather have 20 tenants or 10 tenants in the same income? The automatic answer is I'm going to go for the 10. Why manage 20 for the same income as 10? So one of the ways to increase your cash flow but not increase the number of tenants is to have less debt going out every month. And it also isolates you from market issues. You can always drop your rent to keep it occupied, where the person who's over leveraged is like they're up to their eyeballs in debt. They can't lower the rent or they're going to lose their properties. So debt reduction is not a wealth growth strategy, but debt reduction is a very good strategy for those that are sort of happy at the level of wealth they've created, but now they want to have better cash flow, but not more management.
Yeah, definitely.
I've heard you, John, sometimes use the example of like going to a casino, or that's maybe a good.
Yeah, I mean, think about John's having his birthday, and John's a popular guy, so he's got 10 of his best friends, and we go to the casino, and forget the morals of gambling and all the rest. But the deal for my 10 friends is I get to keep all the winnings if I get lucky enough to win, and they'll fund all the bets. Well, if you own 10 properties and the tenants say, look, leave us alone, don't bug us, we'll send you money every month and we'll pay off all your bills as long as you just let us live in the property. It's like, okay, I'm pretty good with that. You know, they send me money, I let them have access, that's the trade. They get a roof over their house without doing the big commitment. They can give me 60 days, well, 30 days notice. I have to give them 6 months. So that's the deal. They're sending rent, they get access, they get quiet enjoyment, and I get my bills paid off. Hallelujah.
Yeah.
And this works particularly well in Northern Ireland and the Northeast and part of Wales, where you're not going to get a lot of market appreciation. So it still could be great cash flow property, and if the debt's getting paid down, even better.
I'm not sure, Avina, if any of your lecturers in the CAS business school, when you did your masters in real estate investment, used the casino example. I imagine they didn't.
Yeah. Not too sure if I came across that. It's a good example.
There's the difference between education in a university setting and the real life practical experience of someone like John Corey. So, brilliant, Avina, thank you very much for that. Any last minute comments on just earning in general? Again, maybe just before go back to John, you obviously decided to go into this kind of real estate investment analysis as your career. For those who joined late, Avina is our investment analyst within LEOcrowdfunding. She does a brilliant job at being the first port of call when people send us potential projects. So if you're on, I know there's a number of fundraisers here preparing deals here on the webinar this morning. So Avina is the person who has a look at your numbers, checks them, so you can tell from this morning she knows what she's doing, and she is that person that vets what you send to make sure it adds up. So sorry, John, you want to come in there on something?
Just that debt reduction is actually quite key in a lot of commercial loans. A lot of commercial loans are not interest only. They expect a repayment plan built into the loan, and maybe there's a short period of interest only. So while debt reduction sounds like a foreign concept to residential property investors, it's pretty much core to any commercial loan that you're going to take out if you're an HMO landlord or anything else, that they expect a pay down plan over time, and because that's how they've designed the funding.
Yeah. Okay. So, any last minute comments, Avina? Any last minute points you want to make, or anything you want to say?
No, not at the moment. No.
Okay. Listen, thank you very much for your help today, and yeah, people will see more and more of you on these webinars. You'll graduate as the co-host with John and myself soon, and brilliant having your input. So thank you for that. So in terms of then indirect and passive investing, so we've obviously talked about the ways you can earn income, and I think very often people don't actually sit down and realize that there are multiple ways to earn out of property investment. They kind of get on a course and they've found one way, and they don't open their minds to the different ways that actually can suit their if you like, their goals and their aspirations financially, particularly things like the debt reduction John and Avina talked about, because it is something that's relevant as maybe you get a bit older and you're thinking of pensions, etc. But one of the big advantages I think that property offers is this idea of passive investing. So for sure, people can get involved. They can buy their own buy-to-let. They can do their own BRRR, project if they want. Coming with that is the risk of the project. Maybe most of your money tied up in one property. But what property crowdfunding offers is the opportunity to be really earn from all of those different types of earning, but to do it passively by simply investing in a project through a crowdfunding platform. And I think, John, there are a number of advantages for this. And I know that someone like yourself who's been in property for so long, certainly sort of would like you kind of proudly wear the badge that you're a passive investor. So what does that sort of mean to you, and why do you find property crowdfunding being so relevant to that?
Well, personally, I'm lazy. I can look at deals on a computer screen. I don't have to go out and run around. I don't have to negotiate. The deals come to me, and I look at the numbers. I either like them or I don't. And you can be spoiled for choice if the flow is good. Second is, there are people who are very competent at very specific things, and it's taken them 3, 5, 10 years to get to that level of competence. I don't have that time, and I don't have that interest to do that. I don't want to go deep into how to run HMOs at scale. I don't want to become an expert in Sunderland. I don't want to understand the planning rules, the planning guidelines, and permitted development. And I particularly don't enjoy running crews of people. So these are all opportunities that I intellectually understand would be good, but it's not right for me if I have to take the lead. Well, with property crowdfunding, I can spread my money across a few of those things. I can actually get the benefits of being in those investments, but I'm outsourcing a lot of the heavy lifting to someone else. So in my sort of simplified world, if you outsource the work and get most of the benefits, like how good is that?
Yeah, and then I think one of the big benefits of property crowdfunding is that it brings the deals to you, the passive investor. So someone who's registered and they've, through their KYC, their AML, they're investor ready, then rather than having to go out and find deals, the deals are brought to them on the platform for them to look at, which again is something that a lot of people don't realize the time saving that there is, even just in that simple thing. The deals come to the investors. They don't have to go looking for the deals.
I don't have to pick up my phone when someone's calling, an agent or whatever, marketing the latest crap deal. There's a lot of ways that it can be beneficial. I think of this as closer to angel investing in the tech world, where you've been in the game before, you know how the game works, you enjoy the buzz of it, but you are at 5 o'clock, you want to go either get a drink or sit down and have a chat or socialize. You don't want to be trying to figure out how to meet payroll and all the rest. And in particular on property, I'm not signing for any loans. I'm not providing any personal guarantees. I'm not taking any economic risk beyond what I've already invested. Someone could tragically have an accident and I have no liability. I lose maybe my cash investment, but I couldn't get sued. I couldn't lose the rest of my assets. I don't have to show up in court to defend why the ladder was unsafe or whatever. So there's so many advantages for those of us that don't want to be front and center doing the deal.
Yeah, no, I think that's very well put. So it's a compliant environment. Obviously, deals are brought with a chance to invest in different deals. not just different deals, but diversification even in different market sectors. It could be a planning uplift opportunity, it could be a simple development, it could be buy-to-let, HMO, long-term hold. So multiple different types of property strategy as well as multiple deals makes for common sense in investing. Crowd validation, John, we'll sort of finish on this point. Obviously recycling the cash is very interesting, but crowd validation, multiple eyeballs on one deal really has a tangible benefit by way of due diligence, I think.
Yes, but very British to do yes, but I need people to read the documents. I need people to read the information. I need people to think if we're going to get crowd validation to work. So how many of you actually read your mortgage agreements before you sign them? If you're going to sign a shareholder agreement, please read it, at least read the sections that you think represent the core of the deal and try to figure your way through it. Share that reading maybe with other people. We can discuss different sections. Maybe we can even say, look, you read section 8, I'll read section 9, we'll compare notes. Crowd validation, we can sort of offload some of the work. We can maybe get someone who's a particular expert in a topic to provide their perspective because they know more about it. It's a way of balancing the risks by having more people check things and make sure the numbers add up and the words, the commas are in the right places and the signatures match. And another way I'd like to think of this is there's too many deals that are done privately and then it comes out later and you hear about it 3-4 years later. Oh, so-and-so's a rogue and I lost all my money and all this other stuff. And you say, well, did you ask anyone? No. Did you read the documents? Well, not really. Did you, who else invested? Well, no one else invested and I was pressured to invest. It's like, that won't happen here. Lots of people can read the document. There's a very clear timeline. All the information is there that you should need. If you need more, ask for it. It is so much more transparent and better than all this stuff that happens, one-on-one over a coffee and then 4 years later becomes the poster child for fraud.
Yeah. I mean, on our, I don't think I'm in any way breaking confidences, but on our last raise, one of the investors happened to be quite knowledgeable about shareholder agreements. So we're able to make a number of points that added clarity to the shareholder agreement in favor of the investors. Now, the investors who didn't read the document or the final document, probably weren't aware of the tweaks and changes, but because one of the investors had that knowledge, it actually benefited all the investors. And that's one of the benefits, I think, of sort of this crowd validation. So there we are.
So there were, of the audience of the crowd, I know 3 individuals that read front to back the shareholder agreement, which then, because of those 3 people, changes were made, improvements, typos, whatever, and that benefits all of us.
Yeah. Yes. No. Absolutely. So that is covering the earn part of Leo, learn, earn, own, and next week we'll deal with the own part, actually having a shareholding in an SPV that owns property assets, the benefits of that, and why the strategy obviously is so beneficial as you seek to increase your wealth. So I think that's been very interesting on the earn side. And then moving into the passive investing side and why property crowdfunding allows you to access that earning. Now, again, John and I are not FCA or IFAs. We don't give financial advice, so we've talked a lot about pensions and investment, but this is very much on an educational standpoint. We're not trying to steer anyone in a particular direction. Obviously, if you are wanting to invest in any type of investment and you feel you need legal advice, then you should do so. And of course, always read risk warnings and be aware of obviously the level of risk that are involved. So just wrapping up then, again, John and I are available for one-on-one consultancies where we can deep dive into some of the things that we've talked about here this morning, as well as sort of crowdfunding and just general input into the world of property investment. There are the details. You can quickly do a screen grab or take your mobile phone out and take a quick snap. And
or just go to the YouTube site for Leo Crowdfunding and it'll be there for as long as you need.
Yeah, that's a really good point. So again, let me steer people to the YouTube channel. So we're starting to build that up now, which is really good. There's a wealth of material, months and months of these webinars. I mean, the education that's coming on these over time. really is quite substantial. So would encourage people to go on and become a, can't remember all the terminology, that many between Facebook and Instagram and everything else. With YouTube, you subscribe. So please subscribe to our channel. As we build that up, you have to get to 100 before you get some benefits with YouTube. So we're on a big drive over the next couple of weeks to try and build up to 100. So you can help make a difference by going on and subscribing today, if you can, please. And you can obviously access everything that we have done. So that is us today. Again, thank you very, very much for your time. Again, thanking Avina for joining us. Any last comments, John? Obviously not. No comments from John. Any last comments from Avina?
No comment.
Nope.
Nothing there. Brilliant. Okay. So, guys, thanks for everyone for joining. Hope you found it interesting. And by all means, give us feedback. And look forward to seeing you next Thursday at 10 a.m. And we'll talk about OWN and those that can make Tuesday night HMO conversion BRRR webinar around the T5 project Tuesday night at 7 p.m. All the best, guys. Have a great rest of the week and stay safe.